Good day. My name is Mark Woodworth, and welcome to another edition of Lodging Insights. And once again, I'm joined by my good friend and colleague, Jack Cordial. Jack, welcome back.
Glad to be here, Mark.
It's the holiday season, which in and of itself typically makes us feel pretty good, right? But if we think
Except
about
we don't have the Grinch.
we don't have the Grinch this year, maybe because it's been that good a year. And I think we're probably going to tell people that we don't think the Grinch will come back for some time.
Not.
But let's get into the thinking behind that. Much has been happening in the industry, a lot of which is a reflection, obviously, what's happening in the economy. I'm curious, Jack, on your take with respect to we've seen some very pronounced reductions in the level of unemployment nationally, which obviously has come as a function of the level of job growth that we've seen. What is that? What has that done, or what does that suggest as far as impact on the lodging industry?
Well, Mark, a lot of the jobs that are being created, the 220 or so thousand per month, are being created in the strata where jobs were not being created early on after the financial crisis and recession, largely in the educational groups lower than 4 years of college education. So this speaks well for a broader-based recovery, and not only in the economy but also in the lodging sector, because the lower three market segments, chain scales, are now beginning to benefit from their clientele being more able to purchase hotel rooms in those segments.
So specifically upper mid-scale, and the economy segments.
That's right.
Gotcha. Okay. Well, which is interesting because that's pretty much the mirror reflection of what we saw as we began to come out of the Great Recession,
Right.
Where it was the upper priced chain scales that really began to come back more quickly.
Which are still doing very, very well. And in fact, the growth rates in demand and ADR exceed those of the lower still, but it's evening out some.
Okay, so let's put that in the context of 2015. It's mid-December now, so everybody's very focused on the new year ahead. And as we've been saying for some time, the macro outlook remains very, very positive.
Extremely positive.
If you look at the key indicators, it's hard to not tell a very positive story. But let's try to drill down to the next level from a change scale perspective. What are we likely to see within the higher end versus the lower end in terms of demand growth, and I think critically at this point in the cycle, rate change,
Right.
average rate change.
Right.
What do you think?
Well, by the end of this year, all of the segments will have reached long-run average occupancy, and some segments in the upper three categories are at record occupancies,
yeah.
some of them anyway. And that means pricing power is extremely strong right now, and we're seeing that in our forecast for 2015, where the upper three segments are going to receive rate growth in excess of 6%, lower segments in excess of 4%. Very, very strong in real terms because of the low inflation rate. The latest tip spreads indicate that the long-run inflation rate is expected to be about 1.6%. So just doing a quick little arithmetic, we've got a really, really healthy real growth in ADR expected to come forward in 2015.
Okay. Now, when you start talking about tips, the natural part of me says I want to start talking what you think about interest rates, but I'm not going to do that. Okay. But let's look at something else that's now happening as we film this, and that is low oil prices. We saw comparable low in the 50s back in 2009, but that was because of the economy. If we look what's driving low oil prices today, and what do you think the implications are for our industry going forward?
Well, back in 2009, it was a shortfall in demand that was causing oil prices to climb. Now it's this supply surge that's being orchestrated by the leadership of the OPEC nations. Some claiming that that's directed toward the fracking industry in the United States. The OPEC leadership has declared that they will continue to produce oil at a very high rate and add to that supply. So this is a big benefit for the American consumer, as everybody's talked about. It's a big benefit for the hotel industry. All consumers are going to benefit, but those consumers, especially at the lower end of the chain scale segment, they're maybe driving long distances to work are going to probably benefit the most. It may be a while before we see any relaxation in airline prices as a result of this. But certainly, if you just look at it from a pure GDP standpoint, the Wall Street Journal recently, others have indicated that this decline in oil prices, if it continues to go into the 40s, could add as much as a percentage point or more to GDP growth.
Well, I know something that our colleagues within the global research, America's research area of CBRE have been very focused on, and we are going to be taking a very hard look at on a more formal basis, on what the implications are if, in fact, these low oil prices are sustained for a protracted period of time, 2-3 years or more, and what it means for our industry. But I think by almost any measure, it seems it can't be perceived as negative news. It's more of a question of just how much more of a positive might it be.
Yeah, except in the fracking states, maybe.
In certain markets like Houston, they're very dependent. So, again, we know there's that always the risk of making those macro statements. So anyway, lots of interesting things happening in our industry. But again, by almost any measure, you'd have to say they're positive. We continue to be very optimistic about the outlook for the business for virtually all industry participants. And we'll see what happens in 2015. But we wish you the best for a rewarding year, and we'll be back with some more thoughts sometime soon.
Thanks for watching.
Thanks.